All right, so good afternoon, everybody, and thank you for joining us in our final session of the day. My name is Felix Sanchez. I'm a proud graduate of Hostos Community College from the class of 2002, and I'm currently serving as the Alumni Relations Manager here at the Office of Alumni Relations. On behalf of the Division of Institutional Advancement, the Office of Alumni Relations, and Eugenio Maria de Hostos Community College, I extend a warm welcome to each of you attending our Financial Empowerment Seminar this afternoon. It is a privilege to have our students, Team Hostos alumni, dedicated staff, and faculty members in attendance. Thank you for gracing us with your presence. Just a few housekeeping reminders. This presentation will be recorded for future reference. We kindly request that all participants remain muted throughout the duration of the session. We also encourage all attendees to please ask questions throughout the presentation using the Q&A feature at the bottom of your screen. We will have a dedicated time at the end of the session to address all of your questions. Thank you for your cooperation. The Financial Empowerment Seminar was organized to provide the Hostos community with a valuable opportunity to improve our financial knowledge and skills. We trust that the information you receive today will assist you in refining your financial goals and achieving success. For this session's topic, Planning for the Future 101, our first speaker is a licensed mortgage banker at Citizens Bank with over 18 years of experience in the banking industry. A graduate of Baruch College in banking, corporate finance, and securities law, he is centered on economic empowerment, and it's my pleasure to introduce Mr. Fah Islam. Fah, thank you for being here with us this afternoon.
I didn't find any events about Wilson College.
All good. It's my pleasure, Felix. Thank you guys for the opportunity to be of service here today. And what an honor it is to be back amongst fellow CUNY alumni and folks. So thank you all for being here today. I'm excited. Shall I just jump right in, Felix?
Absolutely. The floor is yours.
Thank you. Thank you. I didn't know if there were any other points you wanted to make. Thank you for that. So thank you for my introduction. I am a licensed mortgage banker here in the United States. I'm currently with Citizens Bank. I've actually been with Citizens Bank for about 10 months now. Before that, I was with JP Morgan Chase for about 14 years. I served as their top mortgage banker on the East Coast from 2018 onward. Only say that not as a backdoor pat on the back, but simply to say you've got someone in front of you with a good amount of experience. You've got someone in front of you who survived the pandemic, so familiar with the old way of doing things and familiar with the impact of all the circumstances and how it's played out into everyone's economics. About a year ago, for several reasons, I decided to look at other lenders, and I ended up at Citizens Bank because I believe that of all the other institutions that are there now, this bank is going to be best positioned to be there for the consumer, and it's the bank that I wanted to have the next chapter of my career with. In addition to this, I'm also active in the community. I'm currently working on a couple of projects with the Department of Defense and creating a mortgage program for service workers. I'm also a Freemason, and that allows me to be active within the community. So I share all of that about myself, and thank you guys for giving me 2 minutes to do so. I always think it's important that on the other side of the table, there's a human being just like you. For today's conversation, we're going to use a very, very simple template called the 4 C's of credit, right? Today, we want to talk about financial well-being from the beginning to the end of the economic stages that we go through in life, right? One of the things that my father taught me, right? I'm a first-generation immigrant. My parents came here from Bangladesh. I grew up in Jackson Heights, started off in LaGuardia, went to Baruch. One of the things he always taught me growing up was that here in this culture, they give you so much empowerment and education so that you can learn to do things to make money. And sometimes where he wishes there would be a little bit more emphasis is on teaching us what to do with that money we earn, right? Because I think we've learned the difference between good and great, difference between rich and wealthy, however you want to say it, difference between temporary and long-term, is not so much what you earn as much as it is how you spend what you earn and how you save what you earn. So with the 4 C's, I thought that we would, especially having a mortgage banking background, I thought you guys might appreciate taking the walk first on the things one needs to do to be qualified in order to be a mortgage candidate. because the things we need to do in order to get to that step basically encompasses all aspects of your credit profile, right? And if one achieves that step of home ownership, that's usually the first rocket ship that they have towards their retirement and financial success as a result of, one, not paying rent for the roof over your head, and then two, having the opportunity to build equity and leverage that into your future. So that's what we're going to focus on today, and then we'll segue into the three pillars of retirement. And if anyone has any questions, please do put it into the chat or save it for the end, and I'll be happy to jump on and answer. Okay, you guys are back. Awesome. All right. So now, with respect to getting a mortgage to get a home, there are 42 different things that a bank looks at and an underwriter has to sign off on between when you say, Fah, I think I want to get a house, till the day I say, hey, we're ready, here's the check, let's go to the closing table and get the keys. But we don't need to be concerned about all 42 things. We just need to kind of get an idea of the 4 overall categories that we need to work on in order to achieve what's called being a good mortgage candidate, being lendable, creditworthy, if you will. The first one, we'll look at collateral, right? Collateral, the kind of property that you're going to buy. A home, thank you, Felix. A home, a single family, a multifamily, an apartment that might be a condo or co-op. Depending on what you buy, there'll be different requirements around it and different impacts of equity on your financial picture. Typically, they say a house and a multifamily will grow more in value than necessarily a condo or co-op. Those tend to be anchors. When the market is going up, they take a little bit longer to go up. When the market's coming down, you're a little bit more protected before depreciation hits you. But collateral is the easy one, simply because we don't really have to worry about that today, right? Whatever we ultimately have in lending power will help us determine if an apartment or a house is right for us or a multifamily may be right for us. And when we pick that out, each of those property types have a different down payment requirement, right? If you're buying a house that's a single family that you're going to live in, most banks will let you put as little as 3% down. And we now have some programs with New York State, some with the federal government, where you can kind of put 0% down because either the program allows it for a first-time buyer, or there are grants that'll help cover that 3% for you. So depending on whether you're buying a house or, let's say, a multifamily, where now you have to put, in most cases, 15% down or more. Or if you're buying a co-op where it doesn't matter what the bank says, the board of the co-op is going to tell you what percentage you need to put down, right? That is where collateral comes in, the kind of property you're thinking of buying, and that'll dictate how much cash you need to have ready. And since we're talking about cash, let's go diagonally down and talk about capital, right? One of the things we want to have is savings, right? Whether you're buying a house or not, right? We need to have savings. How do we get to savings? Well, before we get to how we establish savings, let's quickly talk about what are savings. There's usually 2 types of capital or assets. There's what we call liquid assets, right? Liquid because that's a phrase used to describe something you can get to right away. If you need something today, you can go to the account, swipe your card, go to the bank, get access to this right now. And some examples of liquid assets are your checking accounts, your savings accounts, sometimes certain brokerage accounts like money market. I don't want to say cash because we're living in a world right now where any cash you have, yes, it's an asset, but no bank anymore really likes cash, right? Because one, with the Patriot Act, it's difficult for us to paper trail cash. So anything more than certain large deposits, sometimes 1,500, sometimes 2,500, depending on the transaction, we won't allow cash in. So yes, that's an asset. If you've got a bunch of money in a pillowcase or under the mattress, let's talk about why, and let's talk about how we can get that into an account for you so your money can work for you instead of necessarily suffering depreciation at home. So liquid assets, right? Checking, savings, brokerage accounts, potentially cash, but we want to get the cash into an account. What are some restricted or non-liquid assets? Non-liquid assets are savings that you can't get to in a jiff. These are savings where either a certain amount of time needs to pass between when you want to liquidate it and get access to it, or certain steps have to be taken. So things like your 401k, your retirement funds, certain brokerage accounts that require you to sell or execute one or two steps before you can have access to the money. That's typically considered a restricted asset. Doesn't mean you can't get to it or use it. It just means that's not readily available. As a bank, we will look at your liquid assets and your restricted non-liquid assets and take a look at the whole picture and see, how we can, most banks are looking forward to helping you become a homeowner and not. So we'll look at the whole picture and figure out what we can make work and not, and give you instructions on what to do in case we fall short. Right. So we talked about collateral, and collateral is important because the amount of capital we need comes in, and we've talked about the type of capital that there is. Let's talk about how we get to having capital, saving capital, right? Capacity. Capacity speaks to your lending power. Capacity speaks to your credit worthiness. And how do we determine capacity? In a way where, one, as a bank, right, we can't judge a book by its cover. We need to have a rule across all demographics, including the basic stuff, obviously, not what anyone's background is or what they look like, but at the same time, also across all demographics of jobs that you have, of one-off scenarios, of the different types of income that there are, right? Because sometimes you might have a self-employed borrower who's writing off everything under the sun because their accountant is the greatest accountant in the world, and we've got to figure out how to pull back paper income that's not happening, paper losses that are not actual expenses in real life. Sometimes it's simple, and you're a W-2 borrower who's making your hourly, weekly, or monthly income along with any bonuses, and it's cut and dry. And then there's the complicated things like people who receive child support, alimony, Social Security, investment income. So we always have to have a filter of how we can treat all of this in the same light so that there's fairness across the table. So the main formula that lenders use, and this is important, as I started off in the beginning, I said we're going to talk about mortgages, but this really prepares you for life. Because here's a phrase I want everyone to write down: debt to income ratio, DTI. Not just because I'm a banker, but my life is governed by DTI because I'm trying to be a financially savvy person, right? So what I mean by that is debt to income ratio. The amount of money you have coming in every month is your income. The amount of money you have going out every month is your debt or your liabilities. And the debt to income ratio is simply that action expressed as a percentage. So if you're making 1,000 a month, well, let's not be depressing. If you're going to be making 10,000 a month, for example, and your monthly expenses are 3,000 for rent, 400 for a car, 200 for credit card bills, 400 for student loans. Now we've got 4,000 in expenses, 10,000 in income. So our debt to income ratio in this case is 40%. That is your capacity, right? So this is how we get the debt to income ratio. Your expenses versus your income expressed as a percentage. Very, very important.
I'm teaming up with the MTA to spread awareness about the dangers of subway surfing. The consequences are serious and could be fatal. Don't lose your
Shernette, if you don't mind,
stay
put
alive.
us on mute if you don't mind, Shernette. Thank you so much.
Hi.
Thank you. So
I'm
now,
sorry, could you repeat that last part where you said your expenses versus your income? I'm sorry from jumping in.
I sure can. This is important. Thank you for getting the clarification. So, debt to income ratio, your expenses versus your income expressed as a percentage. So income is 10,000, expenses are 2,000, your DTI is 20. Income is 10,000 and your expenses are 6,500. DTI is 65, right? And we can go through more examples at the end, and we can go through any specifics, because I think my contact info was either shared or will be shared. I'm always at your service afterward to help you with one-on-ones. So now we've established what is DTI. Most banks do not want your DTI to exceed 49. I keep looking this way, by the way, to check on time. So you've got my full attention. Most banks don't want your DTI to exceed 49.9. And I think that's insane. Can you imagine if what it costs for your home and your minimum expenses take up 50% of your income? By the time you get your paycheck, Uncle Sam and Auntie Kathy have taken their share, right? Usually 20 to 30% gone right there. If you're doing the other minimum requirement that any financial advisor will tell you, that I sit here and tell you absolutely to do, which is put as much into your 401k as you can, at least match the 401k that your employer will, at least put the amount that your employer will match, right? You're giving away free money if you're not doing that. These things come out. So if we're already at 50 on expenses, taxes and other benefits are going to 30, 40%. You're left with 10 to 20% for transportation, for food. God forbid there's an emergency. So even though the banks allow you to go that high, I don't always recommend you max out your debt to income ratio. And I think the real spirit, the real reason why banks allow you to go that high is because sometimes not all the income in the household is listed on paper. Sometimes the second person's income is not there. Sometimes there's odd jobs. There's various reasons why. But next important thing to remember after DTI is this 49.9 rule that the bank has. But in real life, my suggestion to you moving forward is this. You do not let your housing expense plus your minimum credit expenses, meaning the bills you got to pay, right? Utilities, credit cards, loans, whatever it is. My very strong recommendation is you don't let that exceed 35% of your income. If you can keep it under 30, please do, right? If there's things that you can manage and tweak in your spending habits, in your savings plan, whatever it is, to get that DTI, if there's some sacrifices that you need to make today in order to get that monthly expense ratio as little as possible, brothers and sisters, it will pay you dividends in the long run, right? So if you take away anything today, it's what is my debt to income ratio? How do I live my life? What is the rule that is governing my life when it comes to expenses and my income? Is it at that 35 or is it closer to 50 or 60 or 100? Because let's face it, right? Housing expenses are through the roof, food costs are through the roof, and life doesn't stop. So I get it. These numbers are very ideal numbers. If that's not where you are, let that ring through your head every single day. What can I do to get my DTI lower? The lower your DTI gets, the more your credit worthiness opens up. And we live in a society where whether you make 100 grand a year or 10 grand a year or $1 million a year, if you don't have credit worthiness, you really don't have all the tools you can have your tool belt for financial success. DTI, DTI max from banks, and suggested DTI, 35. Everybody with me still? Give me a couple of nods if everybody is still with me. Awesome, thank you. I'm just pulling my slide back up. So we talked about collateral, the kind of property we're going to buy. That's going to dictate how much we need in savings. We talked about what savings are. And now we talked about how we get to savings by using this formula called DTI. Let's examine where we are. Let's work on getting that DTI down. Feel free to call me for suggestions, for ideas, whatever game plan we need to make in order to help you achieve the ideal DTI for you in order to get to your goals. The last little thing I'll say, since we're talking about mortgages, right? Obviously, we need your DTI low so that when we take on the expense of your new house, and the taxes, or your new apartment and the monthly association or HOA fee, as they call it, right? We got to make sure all those numbers still work for you. We want to make sure that we set you up, not just to say, hey, I've become a homeowner today. We don't want you a month from now, 6 months from now, a year, 3 years from now, to be behind on payments, to have that mental stress. We want to set you up to succeed. So collateral, capital, and now we know capacity and the attention we have to pay. We can talk about various ways to get our DTI lower, right? The easy answer is 2 quick things: more income, less expenses, right? But that's easy for me to sit here and say. How we achieve that, we'll have one-on-ones, and I'll be happy to look at your specific scenario and give you some feedback, right? Sorry, Felix. I know I'm not helping by answering the questions. Thank you. Thank you for
That's not a
reminding.
problem. That's fine.
Thank you for reminding us. So the last thing I saved, because that's the most fun, quote unquote, everyone's got a ton of questions about credit, credit score, credit report, credit history. So let's say you know what kind of house you're going to buy, you got your savings together because you've been working on your DTI, and now your expenses are low enough to take on a mortgage. Great. What's the last thing we're going to look at? Right? We're going to look at your credit report. Very, very important. Very important. There's going to be several takeaways when I talk about credit report, because this is one of the best indicators of your financial health for you, as well as for any institution you're going to do business with. That debt to income ratio thing I was talking about, you need that when you're getting a car. You need that when you're getting a credit card. You need that when you're getting a student loan. You need that when you're even renting. They look at your debt to income ratio. So that's important, and that carries over to our credit profile, except something a little differently. It's called, the first thing I want you to know about your credit history, credit report, credit character, is something called the debt to credit ratio. Everyone probably on this call has a credit card. If you've got a credit card with $1,000 limit and you're using $500 of it, your debt to credit ratio on that card is 50. And then they look at your total debt to credit ratio, right? So let's say you've got 3 credit cards, one with 5,000, one with 10,000, and another one with 5,000. Now you've got 20,000 in credit, and let's say you're using $10,000 worth of credit. Now your debt to credit is 50. If you're using $1,500 and you've got 20,000 in credit, your debt to credit ratio is about 7.5%. The lower your debt to credit ratio, the higher your credit score. I only segued right to debt to credit ratio because we were talking about DTI, so I thought DTC made sense to go into. But here's what I want you to know about the basics of a credit report. And what does a lender look at when looking at this? What does a bank look at when you want to even open an account? This isn't about necessarily taking money in order to achieve your financial means. Even if you open a checking or savings account and you don't have a certain credit score, you can be denied for a checking or savings account. You can be denied if you have a collection on your credit report, right? These are things that are very, very important. So a credit report is a summary of your credit history. What have you ever borrowed? From whom? For how long? And were you a good boy or girl while you did it? Did you stay below the limit? Did you make your monthly payments on time? Did you always max it out and get towards the limit? Or did you not always use everything, right? These things come into play to create a credit profile for you. We have 3 different bureaus in the United States: Equifax, Experian, and TransUnion. These 3 bureaus independently keep track of our social security numbers and all the various debt and credit that we take on. They monitor our monthly payments and our monthly and daily and weekly habits. These 3 bureaus have a formula that they use, and based on that formula, which really nobody knows about, they come up with a credit score for you. So each of the 3 bureaus gives you a credit score between 350 and 850, which is kind of unfair because nobody, if you're below 600, most credit card companies won't give you a credit card. I know Capital One used to work with 560s and 580s. I think even they have gone to 600. So even though you can go as low as 350, really the name of the game is to be between 600 and 850. In order nowadays to get a mortgage, even with the FHA, you need a 620. Most banks want you to have 640. So far, we know that there's 3 credit bureaus and each of them give us a score. What do they base that score on? Right? Certainly on debt to credit ratio. So how much credit you're using compared to how much credit you have. That's huge. That's the number one thing that they use to come up with that score. Then the next thing are things like your payment history. Have you been late? Have you gone past the limit? And how many times, especially the last 2 years? Other things that they use is how many trade lines. A trade line is any kind of debt that you have. A credit card is a trade line. An auto loan is a trade line. A student loan, a personal loan, anything that goes on your credit report is a trade line. Your Con Ed is not a trade line. Your Netflix bill is not a trade line. But any kind of recurring regular debt you have with any institution is a trade line. A credit report wants you to have at least 4 trade lines and at least for 2 years. So as a lender for bigger things like mortgages, when we see that you've been able to maintain 4 little trade lines, a credit card, 2 credit cards, a student loan, a car loan, a personal loan, and 3 credit cards, 4 credit cards, whatever, we see that you've been able to maintain 4 trade lines for 2 years and you've got a score above 640, which means you might have been a little late, but not so much that your score is below 640. You might have used up a good amount of credit at some point or even now, but not so much that you're in the red, right? So those various activities go into scoring, and that gives us a score that helps us determine the type of character or credit profile that any client who's looking for credit, who's looking for lending power, who actually is even looking for any financial services to help grow their funds. These things are all very important. Right, so we've touched on the 4 C's of credit, especially why it's important with respect to getting a house. I hope you guys have seen that in order to prepare to get a home, whether you actually get one or not, you've got to have your house in order. You've got to be paying attention to the money coming in and the money going out. That's rule number 1. Not getting to get anything else done until that's being monitored and under control and there's a game plan for it. That's going to help us to have more savings. That's going to help us to pay our bills on time, which is going to help us have a good credit score. So no matter how you slice it, these steps, whether you ultimately want to become a homeowner or not, will help you have a full, well-rounded financial foundation so that when you get your jobs and you start making your savings, you can take advantage of the full services that are at your disposal in this wonderful country of ours. I'll pause there, and now I'm going to segue into the 3 typical pillars of retirement. I say that because one of the pillars, in my opinion, doesn't apply anymore. Really, 2 of the pillars don't apply, but 1 pillar is being changed out slowly. So back in the day, they used to say the 3 pillars of retirement were pension, Social Security, and personal savings or equity, right? We don't know how long Social Security is going to be there. I'm going to take that off the table. And nowadays, most companies don't offer pensions anymore. So that's actually already in the process in the last decade and a half of being changed to what the new 3 pillars are. The new 3 pillars are, unfortunately, Social Security is still there. The pension has been replaced by home equity, right? Typically now, when you're doing financial planning, 99 out of 100 financial planners will want to know why you're wasting rent, why you're wasting money on rent, and what is your game plan to convert that rent into something that is a payment for the roof over your head that builds equity, right? And there's various ways to do it. Of course, home ownership is the easiest. And then the last one is your retirement and 401k and other liquid savings. So Social Security, potential equity from a home or property, and equity from your brokerage and retirement accounts. Those are the 3 pillars. Social Security, we really can't help right? You have a job, you put in Social Security, you don't control it, don't really control what goes in, you don't control what goes out. It's there, so be it. I teach my nephews, I don't have kids yet, but I teach my nephews. I've got 5 nephews and 2 nieces, and I teach them all that Social Security is there, but I try to teach them how to do personal investing, whether it's the youngest one that still plays around with $150 in the stock market with penny trades, or it's the one that's been working now for 4 or 5 years, and I give him full on advice on what to do. I think these are ideal things to say, but if you really, really prioritize your financial future, everyone on this call should learn the basics of how to follow the markets. If you have a financial advisor, ask them to help you have your own investment account and give you some guidance on whether it's 500 or 5,000 or whatever it is, your play money. Learn the mechanics of the market. At worst, you'll be able to do a better job of judging the people working for you and making sure they're doing the best job for you. And at best, you'll learn something new and you'll have fun investing, and you'll be able to depend on yourself and this other, piece instead of necessarily Social Security on for your future planning. So that's one piece. The next piece is we've covered on this whole call, home ownership. It's important. It helps you build equity. Here in New York, over the last 20 years, we have not gone less than 8% on average year over year in appreciation. Where I live here in Westchester County, right north of the Bronx, we're at 11%, right? You own a house for 5 years, 6 years, on average in the last 20 years in New York City, you buy something, you hold on to it for 5 years, you're probably going to get 50% growth in equity. Average house in New York City today is around 700,000. If that sucker is going to grow by 50% in 5 years, you paid yourself about 350,000 in equity. That's huge over 5 years, right? And that's just one small example. So home ownership, if you haven't been thinking about it, think about it. It is probably not just a pillar of your retirement. It is going to be, as I described earlier on the call, your eventual rocket ship to retirement. The third pillar is your 401k, brokerage, and retirement accounts. You want to make sure you have a 401k and potentially a Roth IRA. A little bit of what the mechanics are of a 401k and a Roth. A 401k is somewhere where you get to put your dollars before you pay taxes on them into an investment account for your future that is managed by a third party. That investment account will grow and grow and grow. You can tap into that savings account, if you will, for 2 reasons. If you need to buy a house and you have money there, you can get a withdrawal or loan against your 401k for the purchase of a primary residence. 2, if you have an emergency. Each plan defines what is an emergency. If you owe taxes, if you have medical expenses, education expenses, emergencies for over your roof, if you fall behind on rent, God forbid, there's ways you can tap into that savings for emergencies or for purchasing a home. But hopefully that's not what you have to do. Even if you do, you pay it back and you let this thing grow for you. Since the dollars that went in were before taxes, the more you put into your 401k, the more likelihood you may drop into a lower tax bracket on the income that you make. That's a great conversation to have with your accountant or financial advisor. Like, hey, I'm putting in 5% now. If I do, 15%, will that drop me into a lower tax bracket so that I'm making a little bit more overall on the money I get to take home versus my tax liability? And if so, you may want to exercise it and you'll win both ways. You're saving more for the future and paying less out of pocket. Not that I hate paying taxes or anything, don't get me wrong. Taxes are what makes our society function. I get it. We need to pay our fair share. But if there's going to be rules there for us to leverage, I think we ought to do the right thing and leverage the rules because they're there for a reason. And that's one way your 401k, your pre-tax dollars go in. When you take it out, you've got to pay taxes on the money that you're taking out, both on the amount that went in as well as the growth. Your Roth IRA, right, is capped, I think, at $5,500 a year, And that's money that you put in after taxes. And that money, no matter how much it grows, when you take it out in retirement, you don't pay a penny in taxes. It's a beautiful, beautiful thing. If you have a good investment mix where you're putting money into the pre-tax so that you're maximizing your income dollars, and you're putting money into the post-tax so that you're maximizing your future tax liability when you need to get that money, right? Because when you take money out of your 401k in your retirement years, who knows? You'll take out 100 grand, you're going to pay 2025 back to the IRS. Whereas you take out the 100 grand from your Roth, you've already paid taxes on it. You don't have to pay anything back. So you need to have a little bit of both. That, along with your brokerage accounts and actual financial planning for, milestones, buying a home, education expenses for yourself or loved ones, medical expenses for yourself or loved ones, any other things, vacations sometimes, right? Some people put grand vacations into their financial planning and they save towards it, allocate funds. So whatever milestones you need to achieve or want to achieve, sit with a planner, have a game plan. I often say to some of my mentees, I encourage my mentees in business to always stay sharp and always stay on top of industry knowledge, to always check in with me and to check in with each other, no matter what. Always, always, always. And they sometimes are like, why? I got this. I remind them that we human beings, we don't just decide something and it happens like this, right? I don't decide tomorrow I'm going to be a lawyer. Tomorrow I'm going to go into the landscaping business and then I wake up knowing how to trim bushes or exercise law. We have to practice. We have to go to people who know this information, listen to what they have to say, talk to colleagues. If you want to become a great basketball player, you got to show up at the court, watch other people shoot the hoop, ask, hey, how's my shot? How's my shoulder, right? So in our financial life, surround yourself with a team. Have a financial planner. Have an accountant. Have a mortgage banker. If you're lucky enough to have an attorney who's good with the financial world, always pick their brains. If you're not there yet, as you get there, because I heard maybe there's some students on the call who haven't started working, who haven't gotten to this point yet, or whatever the case may be, surround yourself with like-minded individuals. Surround yourself with people who have homes, who are in retirement, who are doing the things that they're supposed to be doing in accordance with the information you received on this call. Pick their brains. Ask them about what you're doing. Pick a financial mentor where you can open up about all your needs, all your wants, all your personal habits, right? Be open up front, be honest, and then work the plan, right? Surround yourself with winners, and you too will be one. Thank you guys for letting me be on my soapbox for these last 5 minutes. It's 6:08. I've got 38 minutes of the 40, so we'll have 22 minutes, Felix, if that's okay with you.
That was on point. That was on point. Thank you very much, Fad. I mean, this is a really serious and important topic. We really don't think far ahead of the future and how to get at the position that we're looking for. And I had a question of my own in regards to how do you feel about the S&P 500 investing in the stock market? Is this something, since it's a volatile tool, would you advise to the audience to invest at an early stage in the S&P 500? And if so, what to do if that decision is made?
Sure. Great question. And this is where I get to have fun because I'm not a financial advisor. I'm licensed as a mortgage banker. So I get to talk to you like a human being instead of giving you just compliant answers, right? Because I probably couldn't jump in and say things like the S&P has typically outperformed the market, right, the last 3 decades. And that's the case. If you're thinking about getting into the S&P as someone in the financial world and as a friend, if you were my brother, if you're my family member sitting here asking me that question all day long, I would say yes. S&P 500 is a great investment to get into if you don't want to think about checking every day what's going on, being stressed out about it. Typically, they say every 10 years, the S&P doubles in the United States since the 1920s. So in theory, put $1 in there, you don't touch it, 10 years later, it's going to be $2. And this is where the power of compound interest comes in. The $2 10 years later is turned into 4, the 4 turns into 8, the 8 turns into 16. So every dollar that you put in when you're 20 ends up being about $64 by the time you're 60, which is magical, right? 1,000 at the age of 20 turns into $640,000. Excuse me, $64,000 by the time you're 60. Just phenomenal. So the S&P is a great index to look at, and typically it does outperform most typical financial advisors. Another great tool, if you guys like ETFs, I'll throw out there something called TNA. It is a fund where 80% of the fund gets invested through something called the Russ 2K. We always hear about the S&P, we always hear about the Dow, we hear about the NASDAQ. Those are the biggest companies in the United States. What about, we're a small business country. What about those mid-cap companies? So the Russ 2K, or the Russell 2000 index, is an index of the 2000 top mid-level companies and how they're performing. So 80% is in the Russ 2K and 20% is in the S&P. So between investment in an ETF like Spider, investment in an ETF like TNA, if you want to do worry-free investing that I don't care what happens this month or this quarter, even really this year, I know 5 years to 10 years later, whatever I put in today is going to be more, right? Those are two great options for doing it. If you know what you're doing, you can open an account with the Citizens app, with E-Trade, with many, many places where you can, do this on your own. I like E-Trade, I like Schwab, I like Citizens, because those places you can open the account to learn how to manage it on your own, but you can still call us and say, hey, this is the first time I'm doing a trade. What button do I press on the app because I want to buy $100 worth of this? We'll walk you through it. You can call us and say, I think I want to do this because I'm expecting that. What do you guys think? And they'll give you feedback without saying, we want to manage your money. So it's a great starting tool for folks that want to do it themselves. And of course, all of this advice, most places, I think if you have like 10K or more, they're more than happy to assign you a financial advisor. Even some of the more higher end institutions, I think it's like 25 or 50, you'll have access to a free financial advisor. I know E-Trade, Schwab, Citizens, there's no limit. You open an account with us, you get access to getting our advice on whatever you need to do. So those are some places you guys can get to for that. Any other questions?
No, and thank you. Just to explain to the audience as well, in case you don't know about ETFs, and please, Fah, correct me if I'm wrong. ETFs is a group of companies from the S&P 500 from a specific sector, and they all behave and work together, and you get dividends out of that group. So it's very recommended to invest in ETFs. If one of those companies within that group fails, the other 9 are there to support, and it minimizes losses.
You're spot on, brother. ETF, electronic traded fund, is an investment in a group of companies that have something in common. It could be like what Felix said, a specific industry, a specific niche. It simply could be something a little bit more arbitrary, like these are the top 100 companies in tech. These are the top 100. And it's exactly to do what Felix said, which is if one guy's having a bad day, you protect yourself with all the others.
So suppose I'm investing in just one company like Microsoft, Coca-Cola. Many investors recommend that first-time investors buy an ETF. So that's something that you could research on your own as well. So moving along to another topic, Fah, now that we have you here. Another question, would you kindly provide some advice on the best and healthier ways to use home equity?
So best and healthiest ways to use debt, right? You only want to take on debt if the end game is to have a bigger asset, right? You want to use a home equity to do improvements on your house because it's going to improve the value of your house? Kind of okay. Only for so from a financial sense picture, you put money from a home equity to fix up the house if you're about to sell it. Because if you're not about to sell it, it's okay to do that too. You'll get a temporary value, but then you'll use it yourself. And the new improvements will become not so new by the time you sell it, and some of that value may deteriorate. Worst case scenario, you put a ton of money into the house and it triggers a reappraisal of the home, and now you pay a little bit more property taxes. So if you're planning on selling the home in the next 6 to 12 to 18 months, and you want to use your home equity line of credit to dump into the home and fix it up so you can maximize the dollars you get for it, that's a great use for it. If you're going to be putting, a home equity line of credit debt and using it for an investment purpose, obviously it's a risk. And to use debt to put into a risk is something you should always sit down with an accountant, a financial advisor, and a lawyer and discuss, does this make sense for me, and get all of their feedback. But my clients in the past have taken out home equity lines of credit to do complicated things like invest in companies, sometimes their own, sometimes third party. Back when home equity lines of credit were like 3-4%, I had all these, clients that were like grandma and grandpa's age coming out and saying, Fah, I want every penny that I can get out of my house. Because back then, they have been around long enough to know that if I'm getting a home equity line of credit, or if I'm doing a refinance and taking out my equity, and my debt stays fixed, which doesn't happen on a home equity line of credit, but happens on a home equity loan, the debt stays fixed, but the rate of return keeps growing as the economy improves. So back in, 2020, 2021, a lot of people took all the equity out, dumped it into the market. They're still only paying 2-3% for that debt, but they've been getting 8, 9, 10, 11% back. And eventually, they'll figure out what to do with their next step, and so on and so on. It is a very risky and dangerous thing to do, to take debt against your property and dump it into an investment. So I say it like that. Do people do it? All the time, usually more often than not. But it's something that you need to have your ducks in a row, very much so. So do I, with respect to, do I recommend it? It depends on your situation, and it depends on the investment. What I recommend is, if you have access to debt and you want to leverage it to make an improvement in your financial life, no matter what it is, get professional advice from multiple partners. Next question.
Yes, this is to go back to the DTI talk.
Yes.
What can we do to get our DTI lower? How can we lower it?
So if someone's got a bunch of credit cards right now, and they're drowning in credit card debt, I would say, how do we get those credit card payments low? And I don't want them low so that you're not paying towards the bill. I want them low so you're not throwing money away into the bank's pockets, right? So we'll call the bank up and we'll say, hey, I'm in trouble, I'm in help. Well, you don't even have to go there. Usually you can just raise your hand and say, I have high interest rates. What can you do to help me get it lower for 6 months? I've got a high balance with you guys, and for whatever reason, I'm not able to pay it down right away. That constitutes being in trouble. And what can you help me? For 6 months, can you give me a reduced interest rate? Can you give me no interest rate while I work on bringing this balance down? So if you've got a lot of credit card debt, I would call the companies and be honest with them. Most companies, if you call them and say, hey, my back is against the wall, I need a little help, usually they'll give you a little help instead of waiting for you to fall. Because if you fall, then they're not going to get anything. But if you're like, hey, I maxed out this card for whatever reason, and I'm just having trouble paying down the principal for like 6 months. Can you give me a break on the interest so I can work on paying down the principal as much as I can and getting onto better footing? 6 months later, the debt will be less, my bill will be less. We go back to regular interest. And usually, if you've been doing it for 6 months, you call and you let them know again, they'll help you. So, reducing interest rates, negotiating your debt to a lower interest rate is one way to do it. Looking at unnecessary expenses, right? Personal habits. And then, of course, the easy one, which is making more money, right? Not so easy, but figuring out other sources of income that are sustainable. We never want to do anything short term just for the sake of getting our DTI up or down. When people have a second job, we don't just say, okay, great, you got a second job, here's more money. You have to have that second job for a minimum of 2 years. We want to make sure that you can handle the pressure of 2 jobs, not for a month, not for 6, for 2 years. If we're going to let you borrow money to repay us from the income of 2 jobs, we want to make sure that that is fully a sustainable and stable thing for you to do, right? So we want to make sure we set you up for success.
Absolutely. Thank you. So I'm going to take this moment to ask the audience to, if you have any questions, to unmute yourselves. We still have time for 1 or 2 more questions.
I would like to ask, what is the best credit card to get if you have no credit and you're trying to build it up, like for someone who's leaving college or haven't had a card to begin with?
If you don't have bad credit and just no credit, right? Capital One will give you a credit card all day long. Chase's Slate, their entry level one, will give you usually give you credit. Amex is tough. Bank of America, Wells, they want established credit. Citi definitely wants you to have. Citizens has a Quest card, I believe, that's great for beginners who have credit, who have no credit history, but not bad. And if you go to places like Credit Karma, they will also make recommendations based on where you're, because their algorithm will pick up that you have no credit, and they'll make recommendations and they'll say excellent odds or good odds or whatever. But if they pick up that you have bad credit, right? If you, unfortunately, collections, low credit score, you may be able to still get something out of Capital One. But if not, you would have to get what is called a secured credit card. A secured credit card is this. You give a company, I don't even want to name the names of these companies because they charge fees, they have high interest rates on your own money. I don't want to advocate for them, but unfortunately, sometimes people need them to get their start. You can just Google secured credit cards and you'll get a list, and Credit Karma will also give that to you. So, sorry about that. I just had to skip a call. So, if you have bad credit or for some reason those starter places are not giving you a credit card, then you get a secured, you give them 200 and they'll give you a credit card for 200. You give them 500, they'll give you a credit card for 500. Then after like 6 months, instead of 5, they'll keep your 500, but then they'll maybe up the limit to 800. And after a year, it'll be 1,000. If you don't go late on those payments, if you don't max out that card, after 6 months or a year, you'll start getting offers in the mail. All of a sudden, Capital One will want you to try their venture card. All of a sudden, Chase will want you to try their Slate card. US Bank may come. So, bad credit, you have to get a secured card. No credit, try those places that I recommended. And if for some reason that doesn't work, you go the line getting a secured card. You're welcome, Keisha.
Thank you. Anyone else? Any other questions?
I have one more question. I'm sorry.
Please.
Sorry. So, according to like how will you get a house like the rent to own properties? Is that good properties to start off with if you know, or is the down payment the same as if you went just for like a house that's not rent to own and you still have to put down 10% of the payment to start off with? Is the rent to own okay?
I'm very wary of rent to own. In life, we never get anything for free. So if a seller is not getting their money right away and being able to walk away and start their next chapter, you're going to pay for that, right? And what do I mean by that? Usually, whatever they work out, it ends up being more in their favor than yours. I unfortunately have not seen a single rent to own agreement that wasn't between like loved ones, or in two cases, one guy and this one other couple, just absolute angels that did these other two buyers like the hugest favor of their lives. Other than that, I have never ever seen a typical rent to own situation where it favors the renter. Usually you're missing out. So like you want to rent to own for 2 to 3 years, and then they'll work something out where you get a mortgage, or they'll say you put a certain amount down. I guess that's okay. Or if there's a way, because obviously most people who do rent to own, it's usually because they think there's no other way. And I'll dig deep. I'll find out what the timeline is, what the agreement is. Once we get down to the nitty gritty, I'm like, wait a second. What if you just rented at market rate instead of paying these? You're basically giving a higher amount. Sometimes they're giving a higher amount and only getting a little bit less back in equity. And the only promise is they're going to buy this house at a certain price. I guess that's okay. It's a lot of promises of the future of things not necessarily being in your favor. You're committing to unknown benefits. You're committing known cost. I know that's very general, and if it's a little hard to wrap your head around, just when you get into the nitty gritty, I'm not a big fan of rent to own. And I am at your service. If you want to reach out and run a rent to own agreement by me, give you feedback, of course, 100%. Without a doubt, get it in front of a lawyer, your lawyer, not a lawyer that the seller recommends or the realtor recommends, your own lawyer. Get your own pit bull for these fights. Good. And if you want to have a conversation about what you think the benefits are versus saving on your own, we can have that. It won't take long. Not today, obviously. Reach out to me on the side.
Thank you.
Felix, I think we're sharing my information, right? I'm sure it's there somewhere. I know it was. Oh, sorry, guys. I had it. Is that okay?
A little bit, but what I could do for your information, let this on a separate email too.
Perfect. Whatever's easier. If you guys
I got it. Thank you.
If you want to write down my name and Google me, I'm on Zillow. I'm on the Citizens website, right? Fah Islam. And then just quickly, I'll share my cell phone number. It's 646-339-6218. And I share this. This is not so, it's necessarily about Citizens Bank getting another client for mortgages. You are my fellow alumni. So we are bonded together. Call me for whatever you need. I'm at your service.
Well, thank you, Fah. Thank you very much for your time. We're really grateful of this insightful presentation. Just wanted to tell all of my fellow Hostos alumni to please remain engaged with our institution, as together we can make a positive impact in our communities and showcase the strength and talent of Hostos students and alumni. Before you leave, I would like to extend an invitation to save the date for our upcoming comedy show called Laugh-a-thon, which will take place on Thursday, October 24th. Get ready for an evening filled with laughter, fun, and entertainment, all in support of Hostos Community College students. Mark your calendars and stay tuned for more details. You won't want to miss this night of comedy for a great cause. On behalf of Hostos Community College, the Division of Institutional Advancement, the Office of Alumni Relations, and Mr. Fah Islam, thank you for spending time with us. My name is Felix Sanchez. I'm the Alumni Relations Manager, bidding you farewell. Have a great evening, everyone. Get home safe.
Thank you. Thank you.
Thank you so much.
Thank you.
Take care, everybody. Bye-bye.
You too.
Thank you. Good night.
Good night.